I'm Mark Duggan, the director of SIEPR, and the Wayne and Jody Cooperman Professor of Economics here at Stanford. And it's really an honor for all of us at SIEPR to be co-sponsoring today's event with the Bill Lane Center for the American West. And I'm really delighted to be partnering on this event with Bruce Kane, the director of the Lane Center, to host a symposium that was started several years ago by our good friends John Chauvin and David Kennedy, both of whom shared a deep understanding of the economic, social, political, and environmental issues facing the West. This event has developed as a way to bring academics, business leaders, and policymakers together to explore many of these topics. And Bruce and I are very grateful to all of you for your support of our institutions and for your interest in the issues that we're going to be digging into here tonight. I'd like to also welcome members of the press who are here and thank them for their interest in covering our speakers. And in just a little bit, we'll be hearing from, we have two terrific speakers here tonight who are going to do a deep dive into their areas of expertise and then take some of your questions. So first off, we'll be hearing from Randal Quarles, the Vice Chairman for Supervision of the Federal Reserve Board of Governors. And during dinner, Bruce, there will be a reception after that first part of the evening. And then during dinner, after the reception and during dinner, Bruce will sit down for a fireside chat with Nevada Governor Brian Sandoval. And I should say Governor Sandoval is no stranger to this event because he spoke here in 2014 as the keynote speakers. And I'd say both of our speakers tonight really exemplify the types of policymakers that we like to engage with. They're at the forefront of making and influencing some of the biggest decisions in this region and really throughout the country. And for faculty here at Stanford who are striving to estimate the effect of public policies while considering potential improvements to those policies, it's incredibly important, I think, for us to have this sort of engagement where we're connecting with people who are on the front lines. And both SIEPR and the Bill Lane Center have been trying to facilitate these connections for a long time. The Lane Center is dedicating, I know some people here know a lot about SIEPR, other people here know a lot about the Lane Center, so I'll talk just a tiny bit about each place. The Lane Center is dedicated to advancing scholarly and public understanding of the past, present, and future of Western America. They support research, teaching, and reporting about the Western land and the life in the US, Canada, and Mexico. They focus on governance and policy, the environment, and the history, culture, and arts of the West. And it's been more than 3 decades since SIEPR was founded, and this institution has really grown into a hub here at Stanford for economic policy research. Our scholars do analysis and research that will better inform policymakers and influencers like our speakers here tonight. And we really try hard here also to develop the up-and-coming generation of scholars and policymakers by working with lots of students and people early in their career. So, Bruce, I want to thank you again for being here and supporting both SIEPR and the Bill Lane Center, and to everyone on the team at the Bill Lane Center and, of course, here at SIEPR. And we think it's going to be a great event. So let's get started with our first speaker. And he is going to be introduced by my friend and colleague, Monika Piazzesi, who will lead the Q&A with him. Let me just tell you a little bit. It's really my pleasure to introduce you to Monika here tonight. Monika is one of our senior fellows here at SIEPR and the Joan Kenny Professor of Economics. She's also a professor of finance by courtesy at Stanford's Graduate School of Business, and her research focuses on financial economics, macroeconomics, and applied time series analysis. And I could go on with Monika's many awards. I'll just pick a few highlights. She's been a Guggenheim Fellow. She earned the Faculty Teaching Prize from the Economics Department here at Stanford. She's a Fellow of the American Academy of Arts and Sciences, as well as something called the Econometrics Society. She's an expert on the Federal Reserve and has written extensively on banking, monetary policy, and many other issues. She's mentored and advised dozens of PhD candidates, and we're really proud to have her in our orbit here at SIEPR. And just the last meeting that I had before this event tonight, I met with one of my advisees who's taking a class with Monika right now and has really loved it and enjoyed telling me this story. I believe it was him who told me this story, that earlier this quarter, Monika's a very passionate teacher, and this might give you a sense of how important teaching is to her. Earlier this quarter, that she was teaching, and there was a power outage, and so the lights went out, and it was dark in the lecture hall, but Monika, on the fly, decided she was going to take out her phone, use the light, and sit up there at the board and still write and still taught during the power outage. So the student was, I think, very impressed by that level of dedication. So with that, please join me in welcoming Professor Monika Piazzesi.
Thank you very much, Mark, for the kind remarks. So I'm here in the faculty at Stanford in the economics department, and it's a great pleasure and honor for me to introduce our distinguished guest speaker today, Randal Quarles. Randy is currently a member of the Board of Governors of the Federal Reserve System, and he's a vice chair of Supervision. He's originally from the West. He was born in San Francisco, raised in Roy, Utah, and he was an economics major and philosophy major at Columbia University, and then went on to law school at Yale. In the first Bush administration, Randy served as Assistant Secretary of the Treasury. He then, in 2001, served as US Executive Director of the IMF. That year, Randy also returned to the Treasury, where he stayed until 2006 as Undersecretary. He developed policy on a broad range of issues, both on domestic financial affairs as well as international. And during these years, Randy was an advocate for many things, more regulation of Fannie Mae and Freddie Mac. He argued for fundamental reform of the financial system and advocated extending regulation to investment banks and insurance companies. Randy had also an important role in the Argentinian debt crisis and negotiated debt relief for the poorest countries at the G7 meetings in 2005. After his work at the Treasury, Randy joined the Carlyle Group, a private equity firm in Washington, D.C., and after that became founder and managing director of the Sinosus Group, a Utah-based investment firm. Sorry for screwing up the name. Since October of 2017, he's in his current position at the Federal Reserve Board. So please join me in welcoming Randal Quarles.
Thank you. Thank you. Thank you, Monika, for that introduction. It's a pleasure to be here at Stanford. It's an honor to have been invited by both SIEPR and the Lane Center, which are both institutions that I've long had a fondness and respect for. And it's a luxury to have the chance to talk for some time this afternoon with a group of people who I assume by virtue of your presence at a State of the West Symposium share my love for the part of the world that we call the West. Most of my day job enmeshes me of necessity in either broad systemic questions of global financial stability or the impossibly arcane minutiae of our convoluted and labyrinthine financial regulatory system. Both of those are perfectly worthy, if not terribly soul-expanding occupations, but they inescapably require a relentlessly global outlook. But my first intellectual passion as a very young man was for the history and life of a specific part of the world, the Western United States, as both a place and an idea. And your own presence in the audience suggests that many of you have been moved at some point in your life, as I have been, by the words of Wallace Stegner. If there is such a thing as being conditioned by climate and geography, and I think there is, it is the West that has conditioned me. It has the forms and lights and colors that I respond to in nature and in art. If there is a Western speech, I speak it. If there is a Western character or personality, I am some variant of it. If there is a Western culture, in the small c anthropological sense, I have not escaped it. So that's why I say it's a pleasure and an honor, but most especially a luxury for me to speak to an audience that shares my concern and love for the West on the topic of how the preoccupations of my day job, banking and finance, affect this particular part of the world. We all know that throughout the history of the West, banking and finance have played an important role as vital infrastructure for the economy. That remains true today, although in the modern litany of issues critical to the West, it's often overlooked. A strong banking industry is necessary for households and businesses to engage in the spending, saving, and investment that constitute economic activity, And one of the purposes of financial regulation is to ensure that banks continue to be able to serve this purpose. So it's my plan today to talk about the economy of the West and link the recent and future performance of the Western economy to the central and supportive role banks play as vital infrastructure in their communities. So let's start by defining our terms. What do we mean by the West? Now, before this audience, I approached this question with a little caution because I know that in a broad sense, it's what the Lane Center has been addressing since its founding. But that aside, it makes sense to use a definition, as the Center often does, that includes parts of states in the middle of the country whose economies, heavily dependent on natural resources, ranching and farming, more closely resemble Montana and New Mexico than they do states on the eastern seaboard. But for purposes of these remarks, I'm going to use a less expansive definition comprising the 13 westernmost states. I do so partly because this is a common definition of the West, and because it's the one used by the US Census Bureau in dividing the country into 4 regions, and thus has helped me gather data for this speech more readily. The first thing to mention that distinguishes the West from the rest of the country is apparent on this map. Land area. The West is large, and would appear even larger, of course, if it weren't necessary to shrink the vastness of Alaska to fit on one page. And even using my more modest definition, the West still represents half the land area of the United States. That's important in this context because of one theme I'll be exploring today, which is the economy of the rural West and the banking services available there. As this map should make plain, when we talk about rural America, to a significant extent, we're talking about the rural West. Another way to put it is that while the West is half of the United States geographically, it's only a quarter of its population. 8 of the 13 states in our definition of the West are among the dozen in the nation with the lowest population density. Even after subtracting the large share of unpopulated government-owned land in the West, the overwhelming majority of the West is rural. And yet it's also true that, as most of you know, the West is simultaneously the most urban region of the country. 5 of the 15 largest metro areas in the United States are located in the West, as we've defined it here, and 90% of the entire region's population live in cities, compared to 81% of the country as a whole. Nevada and Utah are among the least densely populated states, but 90% or more of their residents live in cities. Like the rest of the country, the West is urbanizing. I'll return to the differences between urban and rural areas, but first let's look at the economy of the West. The West accounts for 25% of US gross domestic product, almost exactly the share of the US population in the West. For obvious reasons, that's not entirely a coincidence because population relates to labor supply, which is one determinant of economic output. I mention this because it's also true that the change in population over time has a bearing on the economic health of communities and regions and is part of the story for economic growth in the Western United States. And in recent years, that story has been a very positive one. The US economy is strong, and the Western economy is especially strong. While we don't have state or regional numbers for this year, from 2015 through 2017, GDP, after adjusting for inflation, grew 2 to almost 3 times as fast in the West as in the rest of the United States. Since the Great Recession ended in 2010, real GDP has grown twice as fast in the West as in the Northeast, about 50% faster than in the Midwest, and a third faster than in the South. But there's another distinction to the Western economy, one that many in this audience know well, that brings these high-flying results down to earth. While the good times are typically very good in the West, the bad times are usually pretty bad. And that was certainly true during the Great Recession. From 2008 through 2010, the Western economy contracted 4 times as much as the average for all of the United States. The same is true for per capita personal income, which contracted more sharply in the West than elsewhere, as job losses in the Western region during the recession were worse than elsewhere. But taking a longer perspective then, both the boom and the bust times together, and those booms and busts have characterized the West for upwards of 200 years, the West is still the fastest growing region of the United States. Since 2000, real GDP has grown twice as fast in the West as in the Northeast and Midwest, and about 30% faster than in the South. Since 1988, going back even farther, the numbers are roughly the same. Per capita personal income grew faster in the West during good years, outweighing the sharper losses during the recession, and since 2000 has grown about 20% faster in the West than in the rest of the country. The picture of the West leading the nation in economic growth is also reflected in population, a key factor in that growth. From 2010 to 2017, the population of the West increased 7.4% compared to 5.3% for the nation. One might guess that this strong growth is primarily in cities, and in fact reflects the drain of population from smaller towns that is reported to be happening all over the United States. But in fact, population gains in the West are quite well balanced between cities and smaller towns are doing better in the West than elsewhere in holding and even increasing their populations. In the cities of the West, those communities of 50,000 or more, the population grew 7.8% from 2010 to 2017, eclipsed by the 10% growth in southern cities, but well above the 2 to 3% increase in the cities of the Northeast and Midwest. At the same time, the West led the other regions of the United States in growth for towns and cities from 10,000 to 50,000 in size, and likewise for towns between 5 and 10,000. Now let's look at the smallest towns, those with 5,000 or fewer residents. It's this cohort of towns and their people that, to my mind, is really the essence of rural America. There's a widespread impression that small towns all over America are shrinking and that population is shifting to larger towns and cities, and that's the story we can see in much of the regional data. From 2010 to 2017, the average small town shrank by 2% in the Northeast, by 1.4% in the Midwest, and grew, but only marginally, by 1.3% in the South. While larger towns and cities grew substantially faster there and elsewhere. What about the West, where urbanization is happening more quickly than anywhere else? Well, in fact, the average Western small town grew 7.8% in those 7 years, which is roughly the same healthy pace of growth registered in Western towns and cities across the entire range of population. So the message here is that reports of the death of small towns, at least in the West, have been greatly exaggerated. I don't mean to minimize the challenges that small towns face, because they're considerable, or suggest that Western small towns are immune to them, because they certainly are not. But the more positive message I come away with here is that a rising tide of prosperity in the West seems to be lifting communities large and small, and that the many instances of small towns in decline that we all hear about are counterbalanced by other small towns growing healthily. Another lesson is that population growth and the attendant economic growth in the West is not zero-sum, and that small towns can still grow healthily while the metropolises of the West continue to attract people, many from outside the region. I'll return to the issue of how the economies of the urban and rural West differ, but the backdrop is that population data are promising for both. Now that I've outlined how the economy of the West relates to that of the rest of the United States, let me do the same for banking in the West. There's a lot to this topic, but my focus is banking as it's experienced at the retail level by households and small and medium-sized businesses. Again, I use the Census Bureau's list of 13 states to define the West. And for a simpler comparison, rather than each of the 3 other areas, and in honor of Frank Church, I will refer to the other 37 states as Eastern, even though they cover several regions. Some of you in the audience will be old enough to remember Frank Church, the U.S. Senator from Idaho, a Stanford grad, a hero of mine when I was a teenager. When he ran for president in 1976 and had some success in the primaries, he was challenged by the press that said his victories were limited to the West, and he replied, "What do you mean I can't win an eastern state? I carried Nebraska." But one dimension to how households and most businesses experience banking is the number of banks competing for their services. And one difference between the West and the East is that the West has fewer banks, even if we count them on a per capita basis. In addition, banks in the West tend to be larger. One reason for the disparity in the average number and size of banks is that historically, a larger share of Western states allowed statewide branching or had relatively limited branching restrictions, leading to the development of fewer and larger banks. In metropolitan areas of the West, the average number of banks in 2017 was 23, compared to 27 in eastern metro areas. In rural counties of the West, customers had access to an average of 4.6 banks in 2017, compared to 5.4 banks in the East. In both urban and rural areas, in both the East and the West, the average number of banks increased in the years leading up to the financial crisis, but has been declining since then. And while there's certainly more to say about banking services in cities, I want to focus on rural areas for the moment. Over the last 20 years, rural Westerners have consistently had access to something like 20% fewer banks than rural Easterners, which amounts to about one less bank per rural county. That may not sound like much, but that one less bank on average can make a big difference to the households and small businesses inhabiting those rural counties. In any community, access to credit is essential for economic growth. In any community, but especially in rural communities, small businesses are key drivers of growth. Small businesses rely heavily on banks for funding, and community banks, those with less than $10 billion in assets, account for a disproportionate share of bank lending to small businesses. But across the country, the number of community banks has fallen by half over the past 20 years, mostly due to consolidation. This fall has been slightly larger in the West than the East, but the reason I highlight this trend is that I believe it has significant consequences for rural communities in the West. The reason returns me to my single visual aid. The West is vast, and many rural communities in the West must deal with the challenges of isolation from larger towns and cities that few communities in the East face. Rural Westerners have access to far fewer banks than rural Easterners, but that numerical discrepancy understates the disparity when some Western counties are the size of Maryland or Massachusetts, and many are more than 100 miles across, so that access to a limited number of banks can be difficult or out of reach. To provide some perspective on this challenge, let me share what Westerners in one small town have to say about their access to banking services. This account is culled from a series of public meetings that the Federal Reserve is convening in communities all around the country in support of our responsibilities overseeing community banks and promoting community development. Not quite a month ago, we held one such session in my home state of Utah in the town of Green River, population 940, located on the eastern side of the state. It's just off an isolated stretch of interstate, and its economy depends on passersby on that interstate and tourism related to outdoor recreation. In 2014, Green River lost its only bank, and around that time, banks closed in several nearby communities. As a result, most residents of Green River who need banking services must drive the 52 miles to Moab, Utah, which is a fine destination, but this loss has had a profound effect on households and businesses, essentially turning back the clock in Green River by decades as far as access to the banking system. Business owners say their workdays have been curtailed by the need to drive 2 or 3 times a week the 52 miles to Moab to obtain change and make deposits. Businesses have become banks for many residents, agreeing to cash their checks. And because of this new service to many residents, and the long distance to a real bank, retail businesses say they're carrying much larger amounts of cash, which has heightened security concerns, prompted some merchants to invest in new safes. Security is also a concern for residents who no longer have access to safety deposit boxes for valuables or important papers. Faster and more efficient electronic payments hold some promise to bridge these gaps eventually, and the Federal Reserve is working hard on this and making significant progress. But one thing that technology cannot do is replace the knowledge and perspective of a local banker who's part of the community. Relationship-based lending, that is the hallmark of community banking, can stem losses during downturns, since community banks may be able to work with borrowers to avoid losses in a way that a more distant bank is unlikely to. Research has shown that small business lending at smaller banks declined less severely than at large banks during the last recession. Community banks face considerable competition. One of the reasons that community banks continue to succeed in many places is their understanding of their customers' needs and opportunities to invest in families and businesses. The loss of this relationship for a community means that needs will go unmet and opportunities will be lost. In some communities, of course, this may be unavoidable if a town has lost a major employer and has no new industry or plan to replace the jobs lost. But let me remind you of the very encouraging data I cited on the growth of small towns in the West. Overall, rural communities here are growing at a healthy pace, and growing communities need banks. It's my hope that the opportunity for the future that this population growth suggests will support the local banks that communities need to thrive. And a significant part of the Federal Reserve's recent regulatory focus has been aimed at streamlining regulations and reducing the regulatory burden on smaller and regional banks. The Fed, along with other banking agencies, recently proposed a community bank leverage ratio that's designed to significantly simplify the standards banks must abide by for holding capital. As a result, qualifying community banks will only need to calculate and meet a single measure of capital adequacy rather than multiple measures. We've also proposed a reduction in the burden of reporting requirements for community banks and expect soon to propose an exemption for community banks from the Volcker rule. For a subset of the smallest banks, those with less than $5 billion in total assets, we've also lengthened the amount of time between supervisory examinations and expanded eligibility of small bank holding companies that qualify for an exemption to the Federal Reserve's capital rules, a policy that was designed to promote local ownership of small banks and to help maintain banks in rural areas. Most recently, the Federal Reserve spearheaded a proposal to tailor regulation that applies to firms that are larger than community banks, but the potential failure of which generally does not pose risks to the financial system. Those are firms with between $100 billion and $250 billion in total assets. Those changes are designed to reduce unnecessary regulatory burdens on specific institutions without any loss of resiliency for the financial system. By these steps, I believe the Federal Reserve is helping community banks remain competitive and play the central role they've long played as vital infrastructure for rural communities. The future of community banks in these places is one reason that I'm optimistic about the economic prospects of small towns in the West, which continue to grow even as the region and the nation overall becomes more urban. That's a good thing, because small towns, and especially their values, have long helped to define the West, and I hope will continue to do so. Thank you again very much. I'm looking forward to discussion with Monika and some Q&A.
So I thought before we open the discussion to the audience, I thought to ask you some questions that I would love to hear your answers and your thoughts about. So you mentioned the changes in supervision and regulation for small banks. But of course, if small banks make loans to local businesses and local households in terms of mortgages, and suppose the region goes down, experiences a downturn, they could all suffer big losses. So it's not that they're completely risk-free, these small community banks. What makes you feel that we are now in the position to already alleviate the burden on them in terms of supervision? What makes you feel that the small banks are safe?
So for me, it's a question of appropriate calibration for the degree of risk that is presented, as opposed to a complete removal of regulation or a burden. And I do think that it's not at all surprising that in the very complex set of post-crisis regulations that were put in place, which was a decade-long process and a complicated one, it's not at all surprising that there will be opportunities now with experience and able to see the whole picture to step back and say, well, we didn't get this exactly right. We'll turn this dial a little bit. We didn't get these incentives are working at cross purposes. So I think with community banks, I completely agree with you that notwithstanding that there are very many of them, the risks are not always highly diversified. There are many they have similar geographic risks. You have a large number in the same geography. They tend to invest in the same asset classes, and so if that asset class has trouble, there's an issue. So I wouldn't suggest that we should significantly relax regulation, but I think we can reduce the burden of regulation without, and therefore the cost for these banks without reducing resiliency. So as an example, I mentioned that community bank leverage ratio. What that is to say if you will keep a higher level of capital than we require for other banks, of leverage capital, so not the complicated risk weighting process, but just a simple capital relative to your total assets without lowering certain capital requirements for what are viewed as safe assets. If you keep a higher level of capital than most banks, we will reduce the cost of the rest of the complex calculations that have to be made for more sophisticated banks in order to allow them to justify slightly lower levels of capital. We can do that. It's an option for you to say, I'll keep higher capital if I can reduce my cost of compliance. I think that's a reasonable thing to propose.
Absolutely. I like the idea of offering this option of just increasing capital as opposed to undergoing a lot of tests that may be burdensome, especially for small banks. Do you think that that may also be interesting for medium-sized banks?
So it's not something that we have on the agenda to propose for banks that are larger than the cutoff for this community bank option. But I do think that this project of calibrating the burden of regulation to what we think the risks are posed by particular institutions along the continuum of size and complexity in our very large financial system is an appropriate one, and that there are opportunities to do that.
And so let me ask you about the largest ones. For large banks, do you feel that we've done enough to address too big to fail?
Thank you for that question. So for me, the too big to fail issue, going back to the financial crisis, there were institutions that failed as to which policymakers at the time felt that they did not have options other than to intervene and support. And sometimes those options were a result of the interconnectedness of those firms with the rest of the financial sector. They were interconnected in ways that weren't fully understood. Sometimes they were a result of the complexity of those institutions, and it wasn't clear to anyone how they could be resolved or what the attendant consequences would be of a resolution, because there was these gallimaufry of subsidiaries that related to one another in ways that weren't easily determinable in a period of stress. There's been significant progress along all of those fronts in understanding interconnectedness of the system, in creating additional resiliency of other firms to stress at a particular firm, in improving the resolvability, simplifying the structures of even the largest firms. So that I think that policymakers in the future will have more options when faced with particular challenges. And that, for me, was the purpose of the response to too big to fail. Policymakers in the future will have more options as a result of the changes that have been taken. Now, what they do with those options will depend on the particular facts of the situation in the future and the particular people in the chairs. But for me, solving too big to fail was to give them more options, and I think we have.
Let me ask you a final question before I turn it over to the audience. You've been just named chair of the Financial Stability Board, which for those in the audience who are not familiar with this board, it's an international body that coordinates policies of ministries of finance, supervision authorities. Do you have a plan of what the issues are that you'll be focusing on as you start your role as chair?
I would say a couple of things about that. One, as a matter of substance, and one as a matter of process. The Financial Stability Board was set up by the group of 20 nations after the crisis, basically to supervise coordinating all of the regulatory resources of the world and standing up the body of post-crisis regulation. So that has been its focus for the last decade, but that body of regulation is largely complete. And so in the years going forward, I think that the purpose of this body needs to be not constantly looking back to the last crisis, but looking forward to risks that we might see in the global financial sector, and determining what the nature of those risks is and whether a supervisory response is required. And up to now, that part of the FSB's mandate, if you will, has been less important for obvious reasons than ensuring that we have put in place the bulwarks against what we knew to be the causes of the last crisis. So going forward, that forward-looking review of vulnerabilities is something that I think needs to be more methodical. Up to now at the FSB, it's been relatively reactive and ad hoc. I think it can be more methodical in the context of a framework of how to identify and then evaluate the nature and severity of vulnerabilities. On the process front, there's been a lot of criticism, particularly from the U.S. From U.S. politicians, of the FSB's what they view as its hermetic secrecy, a black box that sits in Basel, as to which and issues edicts, but doesn't take a lot of input. I think as a process matter, and I view this about all regulation, it's something I think is important at the Federal Reserve as well. We improve our outcomes when we take in a lot of input. So I want the FSB to have a lot more transparency, more outreach to all sorts of constituencies around the world in both in evaluating financial vulnerabilities and determining what our response ought to be to them.
So let's open the floor to questions from the audience. Yes, it's you. Please.
Hi, Jeanette Garrity, Reinhardt. Looking back to the Great Recession, since you brought it up, I'd care not to bring it up, but that's all right. A lot of the risks seem to be outside of the banking system. So I'm curious about, you talked about the banking system in the West. How does the non-banking system work in the West, and what's the positives and negatives of that?
So that's a very good question. I think the non-banking financial intermediation in general is a difficult question from the point of view of regulation, but one that we have to stay on top of. As we have put the regulatory response in place, I would say the clearest and probably the most stringent regulations have been put on the banking system, and that has resulted in a much stronger system, and it's a pretty healthy system. It certainly is currently very profitable, and the U.S. banking system is the strongest in the world. But over time, that will result, if you have a difference in regulatory stringency in different parts of the financial sector, you're going to drive activity to weaker parts of the system. So I think that we need to one of the things that we do at the Federal Reserve is that we do have a research function in which we observe data across the financial sector as much as we can, even though we don't have direct supervisory data on non-banks for the most part, and try to see how we see risk evolving across the system. At the moment, we're comfortable that the level of overall financial stability risks is moderate, notwithstanding this, the potential incentives that are created by regulating the banks versus the level of regulation of the non-banks. But that's something that we always have to be vigilant about and are continuing to be.
Yes.
You talk about community banks. Let's take the case of Green River. Was that a standalone bank there? Or how do you handle the distinction between a standalone bank in a community as opposed to a branch of a much larger bank, and the kind of regulatory softening's not the word I want, but at any rate, that would not apply to branches of much larger banks that have chosen to establish themselves in small communities. So how do you deal with this? Because it seems to me that there really is a question, very real possibility in these small communities of getting banking into them with branches as opposed to small standalone banks.
So there is, although our experience and the experience of most of these communities is that when banking is provided by a branch of a larger and more distant bank, that some of the positive effects of having a local community bank, and when we talk about community banks in a community, they usually are headquartered and local in that community or in a very nearby town because they have a relatively small number of assets. As evidenced by the data that I mentioned, that in the downturn, smaller banks and community-based banks reduce their lending less than large banks. So it's large banks tend not to have branch networks in places where there's not going to be a single community bank. And even when they do and are providing access during good times, they tend not to be as strong a support for those communities in the hard times. So that's one of the reasons why, obviously the largest banks in the country are, very important contributors to the financial sector, and having our regulation efficient for them is also very important. But we do try to have a special program of support for community banks because we do think that they provide support in a way that the larger banks won't for those communities, even when they're present.
Thank you for your comments, Mike Lepek from the School of Engineering. How do you see the role of state-chartered banks versus federally chartered banks, particularly here in the West? And I'm thinking about Jan Owen's efforts in thinking about cryptocurrencies at banks for Silicon Valley, or chartering financial institutions that may service commercial activities that, while legal in California, may be illegal at the federal level.
You have any activities in mind? So the state chartered versus federally chartered system, that we've had since the 19th century, I think it's I think that it's very useful because there are sometimes particular circumstances within a state that a state charter can take more advantage of. For the most part, a bank makes that determination less on the state versus federalness of it as sort of an abstract matter, and more on the particular regulatory environment in a state versus the federal charter at any particular moment, and that evolves from time to time. So I view that, and always have, less as a question of the merits of state versus federal chartering and more as the merits of competition in any human activity. And over time, that will evolve, and sometimes that will mean that a national charter is the right thing to do in a particular circumstance, and other times a state charter will be the right thing to do. The Fed sits over them all and generally prevents anything from getting too far out of line. So thank you for limiting me to 30 seconds because that is that's a potentially very large question. So I think that what but a very important one. I think that what we can do at the Fed is to ensure if you have an economically vibrant community and the presence of local banking services in a community is an important part of that. Again, as opposed to have to travel, make a 100-mile round trip a few times a week in order to get quarters. You're going to have an environment in which those sorts of social issues are more easily addressed. They're hard for us at the Federal Reserve, obviously, to get a handle on. But our piece of that, and one of the reasons that we are, again, we could spend, and much of my day job is spent with the very largest financial institutions, but the reason that we take our resources and focus a significant portion of it on community banks is precisely for that reason. We do think that that they contribute to the vibrancy of those communities, and that's important not just for economic reasons, but for a broader set of reasons as well, including health. So it's a good question. For the most part, across broad regions, there aren't significant differences in the supervisory focus on those money laundering questions. There are obviously certain communities and smaller sub-regions where there will be more of a focus for obvious reasons, some border communities, et cetera, or other areas. But for the most part, the difficulty with the burden that's associated with money laundering regulation relative to or money laundering supervision, bank examination relative to loan review is a function of technology. We're advancing more quickly the technology that we can use to facilitate loan review and to do a lot of it off-site and make that a lot easier than we currently have been able to do with respect to Bank Secrecy Act and money laundering issues. But we are working very much on that. In fact, we just came out a week or two ago with a statement encouraging banks and giving them the regulatory ability to use new technology in addressing some of these money laundering questions, that we would, as supervisors, not criticize them for it. And in some cases, they're using old technology because bank supervisors were criticizing them for doing something differently than the way it had always been done, and we were more advanced in how we were looking at loan review than we have been for Bank Secrecy Act. It is a very live project right now among the concerned agencies, the bank regulators and the Treasury and FinCEN, which is the Financial Crimes Enforcement Network that focus on these money laundering issues, to reduce the burden and cost of this regulation, which is a huge amount of cost on the system. And so I think this is something that one will see over the course of a couple of years for it to play out, but I think we will be able to get that cost down significantly.
John Taylor.
Randy, when I saw the map, I was reminded that another map could have been Federal Reserve districts in the country. And the Western is mostly one Federal Reserve district. Maybe Kansas City gets a little bit of that. The question is, do you see, in light of the changed geography, economic activity since 100 years ago, whether there's a need for any adjustments, and in particular with respect to supervision regulation, because a lot of that is done by the district banks and supervised there. And then, and in particular, you see any changes? You know, San Francisco doesn't vote as much as New York, doesn't have as much, or Cleveland and Chicago, I believe.
Mm-hmm.
So, are there some possible reforms that you're thinking about, whether whatever it happens to be related to your area?
So that's a great question. For those who, for those who aren't aware, there are 12 Federal Reserve districts that were drawn in 1913 and haven't really been changed since. And it's not 100% clear that they made sense even in 1913 because there are 2 Federal Reserve banks in Missouri and one in San Francisco that covers almost all of the West. It covers a third of the country and a quarter of its population. And the difficulty and if you were drawing those districts today, you would probably make some changes. The difficulty with changing them is that would require a legislative process to amend the Federal Reserve Act, and who knows what else would get changed. So the Federal Reserve System has been evolving over the course of the last, call it 30 years, to operate much more as a single system with the various Federal Reserve districts serving less as geographically isolated or anchored banks, and rather each bank serving its role in an integrated system. So one bank is assigned certain responsibilities for some Federal Reserve products or processes, and another bank has more responsibility for others. All of the check cashing in the system currently is done in Cleveland, for example. And the Cleveland bank, I think, processes fewer checks in a month than used to be processed in the Salt Lake City branch in a day in the 1970s. But it's all viewed as increasingly viewed as one system, as opposed to these geographic anchors with responsibilities for the geography in which they're placed. So in that environment, I think it works for us not to redraw the Federal Reserve districts, but rather in non-legislative ways to try to integrate the system, and we've done a lot of that. In the supervision and regulation area, for example, we've established a program that draws for the largest banks, not the very, very largest banks, but for the top 30 or 40. Supervisors are drawn from reserve banks all across the system and work as a single unit, if you will, to coordinate supervision. And that, again, is something that we've done without changing districts, but simply as an administrative matter within the system.
I think we have time for one last question.
So there's clearly a connection, which is one of the reasons, and a close connection, which is one of the reasons why the Federal Reserve as an institution has always believed that bank regulation and supervision is an important part of its responsibility. Over the years, there have been proposals to separate bank regulation out of the Fed, and examples exist of that internationally, where central banks have had bank regulation and had it taken away and had it put back. I think the intellectual consensus currently probably is globally is that bank regulation in important ways does belong in a central bank because of the connection to monetary policy. In the current environment, the closest connection is, I think, with our liquidity regulation. So we, somewhat surprisingly, given the importance of liquidity to financial institutions, regulation of the liquidity of those institutions had not been an important element of bank regulation, had not been as high a focus as you would have thought it would have been before the crisis. Since the crisis, it's become very important, and as a regulatory matter, we have greatly increased the liquidity of the system. One of the consequences of that is that the size of the Fed's balance sheet is much larger than it was before, and in the process that we are currently in of normalizing the balance sheet, we aren't perfectly sure, we can't tell as well as we might have without that change in liquidity regulation what size the balance sheet is going to shrink to, because we have affected banks' demand for central bank reserves through our liquidity regulation in a way that we know exists, but that we don't really know the contours of. And so we will see the contours of that as we slowly continue to shrink the balance sheet until we get to a point where changes in the size of the balance sheet are clearly affecting the cost of bank reserves because we will have gotten to the point where to the steep part of the demand curve for reserves, but we don't know where that is yet because of our liquidity regulation. And so as that process evolves, there may be changes that we need to make to our regulation of liquidity in order to, if we believe that there are certain outcomes that we want with respect to the balance sheet, and all of that is relatively new territory because of this new emphasis on liquidity regulation.
Great, thank you very much, Randy. I'll turn it over to Mark. I'm
So
getting the
thanks
stop sign.
so much,
Thank
Monika
you.
and Randy.